Hey guys, we are back with the 6 steps to financial independence, and today I'm going over step 3, which is proper protection, also known as risk management. Now, over the long lifespan of accumulating assets, of building wealth, of planning for retirement, stuff is bound to happen, especially in this crazy world we are living in nowadays. So, should some sort of unforeseen circumstance arise, obviously we never plan for these types of things, but they happen. We need to have a hedge against that uncertain loss. You need to have a plan in place that is going to prevent against loss of income, keep money in your pockets should an emergency arise. You need to have something that's going to protect and preserve your assets. Yes, I am talking about insurance. Now, insurance is a little bit of a dirty word for a lot of people, and I believe the reason is because they don't quite see the value until they need it. Now, think about it. Why do you have car insurance? Why does car insurance give you peace of mind? So in the event you're just driving along, minding your own business, somebody T-bones you, it's not your fault, you are not going to have to write a big check out of pocket to repair your vehicle. Or health insurance. Say we're walking along, just minding our business, we slip on a banana peel, fall, break your hip, and now you have to go to the hospital, you need to have surgery, so on and so forth. Are you going to want to write a check out of pocket for those massive expenses? Absolutely not. In those situations, that insurance comes in huge to protect against a loss of income. Now, when we're talking about personal finance, there's 3 areas of insurance we want to look at. We want to look at life insurance, term versus permanent coverage, and I'm going to get into that in a little bit greater detail. Next, we want to look at LTC, long-term care insurance. Now, this is the type of coverage that comes in handy if anyone develops a chronic illness. This is a type of health insurance, but your standard health insurance, that's only going to cover what's called acute conditions. You're in the hospital for a short duration of time, your standard health insurance is going to cover that. But what happens in the event that you develop some sort of chronic illness or handicap where now you need assistance getting around the house, getting in and out of the tub? Somebody develops a cognitive disorder that prevents them from caring for themselves properly. Skilled nursing, home care, those costs can be astronomical. So part of being responsible and protecting against a loss of income for not just yourself, but your younger family members is having long-term care coverage. Lastly, disability insurance. This is the type of insurance that's going to replace a portion of your income should you get injured or sick and you are now unable to perform the duties of your job. Think about it. If you rely on a paycheck and all of a sudden you have some sort of injury or illness occur where you are now no longer able to perform the duties of your job, you are now no longer able to acquire that paycheck, how long are you going to last? How robust is your emergency fund? Is it going to be able to bridge that gap? Maybe, maybe not. So that's where disability insurance can come in handy to help bridge that gap while you are recuperating from your injury or your illness. Say it's 9 months, a year, whatever the case may be. Going to dive a little bit deeper into life insurance. What's best for me? Now, life insurance can be very complicated. There are a ton of different policies and plans out there, and navigating through that can be a little bit difficult. But life insurance breaks down to 2 major areas: term and permanent insurance. Now, term insurance is what most people are familiar with when they think of life insurance. I like to call it death insurance. I know that's a little grim, but that's kind of what it is. Now, term insurance is exactly as it sounds. It is good for a certain term. It has an expiration date. You have 10, 20, 25, or 30-year term policies. Now, the great thing about term policies is that they are low cost and high benefit. Meaning you can get 6 to 7 figures of coverage for as little as 15 to 20 bucks a month, depending on your age and your medical history. That being said, there are some drawbacks to term policies. These are defensive only. There are no living benefits to term policies, at least the vast majority of term policies. Meaning it's similar to car insurance. You pay into it, you pay into it, you pay into it every month. If you never have an accident, then you lose that money. It's the same thing with term policies. Maybe you get a policy when you're 30, it's a 20-year term. You're 50 years old, I'm still here. Now you need to get reinsured, you're older, it's going to be more expensive. That is why insurance companies absolutely love term policies. Only 1% of term policies ever pay out. That's why they're so inexpensive, because insurance companies know their risk is relatively low. The likelihood that they're actually going to have to pay out a death benefit on a term policy is low, so they're able to offer it. Now, on the other side of the fence, we have permanent policies. Permanent policies are just like they sound. They are permanent, and they break down into two major categories. We have whole life as well as universal life policies. Now, universal life breaks down into several subcategories as well. I'll cover that in a separate video. Now, what's great about permanent policies is they have a cash value component, meaning not only do you have the defensive protection of the death benefit, you also have a cash value savings and investment component as well, meaning you can access living benefits in your policy while you're still here. Supplement your retirement income, send your kids to school. Should you have a sudden emergency and you need to pull money from your cash value, you can do that with no penalties. A little bit different than your IRAs and 401ks that have that 59.5 penalty. So, they are for life as long as premiums are paid. Pretty fair deal, right? Of course, there is a drawback. These are going to come at a higher cost. Not only are they permanent, but they also have that cash value component. You're going to pay more for that. That being said, middle-class individuals can still afford permanent policies, and that's a common myth that they are absolutely out of the price range for anyone who is not rich. That's just not true. So they have both offensive and defensive components, as I had mentioned. The last area I want to talk about is determining someone's life insurance need. Everyone's situations are different, everyone's family is different. Not everyone is going to need the same policy. It is not a one-size-fits-all type of thing. So how much do I need? How do we determine that? When I sit down with clients, I use a method called the DIME method. D-I-M-E. That stands for debt, income, mortgage, education. So we're starting with D. D is for debt. I'm sitting down with a client, I ask them, if you were to pass away tomorrow, how much outstanding debt would be passed along to your survivors? That debt doesn't just disappear, especially if you have things like co-signers on loans and things of that nature. Next, I. I is for income. If you have people who are dependent on your income and your income was suddenly taken away from the family, that could have a major, major impact. So, how much do you earn? How long would you like to provide survivor benefits? How long would you like to replace your income in the event that you are no longer here? 10 years is a good rule of thumb there. M is for mortgage. Do you own a home? In the event that your family that is dependent on your income no longer has that income, are they still going to be able to pay the mortgage, or are they going to lose their home? That could be catastrophic for your survivors, so that's something you should definitely consider if you are a homeowner. E is for education. Now, education is for leaving an education fund, a college fund for your young children. Say they're still in middle school and unfortunately you were to pass away. Are you still going to be able to send them to college? Are you going to be able to provide them with that legacy, with that gift when you are gone? So what we're going to do is we're going to go ahead and cover each of these factors. We're going to see which ones apply to you, to what degree they apply to you, and we're going to go ahead and add that up, and that's how we're going to determine someone's life insurance need. So I hope this video has been beneficial. Stick around. We have step 4, the 6 steps of financial independence, coming up soon.